Good morning, students, and today we will be discussing the chapter that is government budget and the economy. Now we are coming to a meaning of budget. Budget is a statement of estimates of government receipts and government expenditure during the period of financial year, or you say fiscal year, which runs from 1st April to 31st March. And to understand this budget, if you come to the features of budget, then you will see it is an estimate, not an actual statement, and it is prepared annually. That's why we say it is an annual financial statement, and it is a constitutional requirement that the budget is to be presented before the parliament, and whatever revenue and expenditure they are planned according to the objectives of the government. And budget impacts the economy through aggregate fiscal discipline and resource allocation. So after this meaning of budget and what we discussed about features, we are coming to objectives of budget. And the first objective is that is reducing inequalities in income and wealth. That means in government budget different provisions will be there. The gap between the rich and the poor is to be reduced. That means we can say the essential commodities to be provided to the poor people at a subsidized rate, at a lower rate, and at the same time the rich people, they will be taxed more, so that the gap between the rich and poor is to be reduced. And reallocation of resources are to be reallocated, means in different areas, and keeping in objective in mind, that is social welfare of the people, that what resources will be allocated in which areas of the economy, that is to be decided, and those provisions are to be kept in the government budget also. In economic stability, to maintain economic stability, it is another objective of government budget. And to maintain this economic stability, government generally how it deals, that means if there is a inflationary situation in the economy, the government prepares surplus budget, and if there is deflation or deflationary situation the economy is facing, that time that the government prepares deficit budget. By this way the government tries to maintain economic stability in the economy. So these provisions are made in the government budget. Then next objective is direct participation and economic growth by managing public sector enterprises. Means the government is participating in economic growth, participating directly in managing the public sector enterprises, to keeping it in mind that more you can say objective is social welfare and to create more employment opportunities. Now next one is economic growth, or that is the growth of the economy, that is another objective of the government budget. And growth means in different areas, in agricultural, industrial and service sector, different growth rate are fixed, and how that to be achieved, how the resources to be allocated in those areas, that have to be fixed in government budget. These are the objectives of budget we discussed. Now we are coming to components of budget. In components of budget, you see there are two components of budget. One is budget receipts, another is budget expenditure. In budget receipts, two types of receipts you will get: revenue receipts and capital receipts. And in budget expenditure, you will find out revenue expenditure and capital expenditure. And if you come to the meaning of budget receipt, that means all the estimates of money receipts, estimated money receipts, remember, of the government from all sources during the fiscal year. That means the government, whatever receipts they are getting from all sources, they are budget receipts, and it consists of revenue receipts and capital receipts. And in revenue receipts, you will find out that those receipts will do not create any liability for the government, or do not reduce, or do not lead to reduction in assets of the government. They are all revenue receipts. So you can give the example that all the tax receipts, they are not creating any liability for the government, so they are revenue receipts. And fee, fines, penalty, all these are non-tax receipts, and they are not leading to any reduction in assets of the government, so they are clocked under revenue receipts. And after revenue receipts, you see, just now I told you that tax receipts and non-tax receipts. Tax receipts, income tax, corporation tax, goods and services tax, all these are tax receipts. Non-tax receipts are fee, fines, penalty, receipts, grants, all these are non-tax receipts of the government. And if we discuss about the tax, what is a tax? A tax is a compulsory payment that is made by the individual or a household or a farm to the government without anything corresponding in return. That means it is a compulsory payment, and the revenue received through taxes is spent for public welfare, but there is no proportional relation between the tax and the social benefits offered correspondingly. So payment of taxes is the personal responsibility of the person, and they are also imposed legally. And if we discuss types of taxes, then there will be direct taxes and indirect taxes. Direct taxes are those taxes whose final burden falls on that person who makes the payment to the government. That means impact and incidence. Incidence, that is the final burden of the tax. So impact and incidence of the tax fall on the same person. We say direct tax. Income tax, wealth tax, they are all direct taxes. And if we come to indirect taxes, that means here the impact and incidence of the tax fall on different persons. That's why we say indirect taxes can be shifted, whereas direct taxes cannot be shifted. So for example, example of indirect tax is goods and services tax, GST. And non-tax receipts, just now I told you that receipts from other sources other than the taxes. That means fee, fine, penalty, escheats, and special assessment, gifts and grants, income from public enterprises, interest on loan, forfeiture of bonds. These are all non-tax receipts coming under revenue receipts. Now we are coming to capital receipts. Capital receipts are those receipts of the government which create a liability for the government, that is, or you can say lead to reduction in assets of the government. Creates liability for the government, that is borrowing, means whatever the government is getting from borrowing, they are all you can say capital receipt, they are creating liability for the government. And whatever the government is getting from disinvestment or recovery of loans, they are all leading to reduction in assets, and they are coming under capital receipts. And it consists of borrowings from within the country and abroad, and other receipts, for example, selling a part of the equity of public sector undertakings, which is otherwise known as disinvestment, and the recovery of loans from state governments or other debtors. They are all known as capital receipts because they are all leading to either creating liability for the government, or they are reducing the assets of the government. That's why they are all capital receipts. And now we are coming to budgetary expenditure. When you come to budgetary expenditure, it refers to the estimated expenditure of the government during the fiscal year, and it may be classified as revenue expenditure and capital expenditure. And in revenue expenditure, you will find out that all the estimated expenditure of the government in a fiscal year which does not create assets of the government and does not cause a reduction in liability of the government. That means any expenditure which does not create any assets for the government, or any expenditure which does not cause any reduction in liability of the government, they are all revenue expenditure. And in capital expenditure, if any expenditure is creating assets for the government, or any expenditure which is causing reduction in liability of the government, they are all capital expenditure. For example, if the expenditure is done on the construction of dams and steel plants, that means asset is created for the government, and that is capital expenditure. And repayment of loan, that means the liability is reduced, liability is finished, repayment of loans. So repayment of loans, that expenditure is capital expenditure. And we are coming to budget deficit and its types. Budgetary deficit is defined as that is total estimated expenditure over total estimated receipts. That is excess of total estimated expenditure over total estimated receipts. That means estimated expenditure is greater than estimated receipts. So when government's expenditure exceeds its revenue, it incurs budgetary deficit. And types of deficit, if we come to, one is revenue deficit. Revenue deficit means in the revenue budget you will find out that total revenue expenditure, if it exceeds total revenue receipts, then we say there is revenue deficit. And in fiscal deficit, when total expenditure is exceeding total receipts, and in total receipt there is no borrowing, that means excluding borrowing, then we say there is fiscal deficit. And in primary deficit, if we are deducting interest payments from fiscal deficit, then we are getting primary deficit. Then revenue deficit, it occurs in the revenue budget of the government. In revenue budget, one is revenue expenditure one side, and the revenue receipt. So from revenue expenditure, if you are deducting revenue receipts, whatever is there, that is revenue deficit. If we come to implications of revenue deficit, that it indicates that the government is not able to meet the expenditure for the routine functioning of the economy. And the dissaving of the government account, it implies dissaving of the government account because the government is using of savings of other sectors of the economy to cover up this gap between the revenue expenditure revenue receipts. And it implies also a revenue deficit implies that government has to make up this deficit by disturbing its capital budget. That means either borrowing or you can say from a sale of its assets. And a use of capital receipts also may lead to inflationary situation in the economy, and higher borrowing also would lead to an increase in the future burden of repayment of loan and interest payment also. Now we are coming to fiscal deficit. Fiscal deficit refers to that is excess of total expenditure over total receipts excluding borrowings. And implications, if we discuss, it will lead to debt trap, and there will be foreign dependence, that means does not carry the load of interest payment on account of past loans. That will cause the inflationary situation in the economy. There will be financial burden for future generation also. They are the implications of fiscal deficit. And simply you can say fiscal deficit indicates that how much the government has to borrow. That means the borrowing requirements of the economy is indicated by fiscal deficit. And primary deficit, that means if we are deducting interest payment from primary deficit, fiscal deficit, then we are getting primary deficit. And implication is that is primary deficits are similar to those of fiscal deficit. Implications are similar to fiscal deficit, but only difference is that the primary deficit does not carry the load of interest payment on account of past loans, and primary deficit just indicates the borrowings when current year expenditure is greater than current year revenue. With this we came to an end of this chapter. Thank you.